John has $100,000 and one decision to make. 3 ETFs in front of him: SCHD, JEPI, and VOO. Which one's better? Well, that depends, because there are two completely different answers to this. In this video, John's putting $100,000 into all three. I'll show you what these 3 ETFs are all about, how they're designed to grow his money, what's inside each of them. We'll discuss their historical performance and cover how well they did overall. At the end, I'll show you how $100,000 is projected to grow in each of these funds. One grows to $1.8 million, one to $3.7 million, and one to $4.6 million. Two of them pay John around $12,000 to $13,000 a month by the end, while the third pays him less than $500 a month. But before John puts a dollar anywhere, he wants to know what he's actually choosing between. So, each of these ETFs is answering a different question. SCHD is built to pay him, and to pay him a little more every year. JEPI just wants to hand him the biggest check it can starting month 1. And VOO doesn't really care about paying him at all. It's there to grow. 3 answers to the same question. They can't all be right. So John wants to know what he's buying before he buys it. And that starts with the price tag. We start with the fees because that's the one thing John pays no matter what happens. Vanguard's VOO charges 0.03%. On $100,000, that's about $30 a year, which is basically nothing. Schwab's SCHD is a little higher at 0.06%, so $60. Then there's JEPI at 0.35%. That's $350 a year out of the same $100,000, and it's roughly 12 times what Vanguard is taking. It does buy him something, though, and we'll get to that shortly. Now, the size of these things, because they're not really in the same league. VOO is holding around $978 billion. SCHD is at $104 billion, and JEPI is at $45.8 billion, which sounds small sitting next to those two, but it's honestly massive for a fund this young. Same story on trading. VOO moves about $5.44 billion worth of shares on an average day. SCHD does $708 million. JEPI does $304 million. 2 more things off the profile page, and the second one's strange. VOO opened in 2010. SCHD came along a year later, and JEPI didn't launch until May of 2020. And where Schwab and Vanguard both get listed as U.S. equity, JEPI gets listed as alternative. By the way, that's a category, not an insult, but it's a hint. Because the profile page can tell John what a fund is called, it can't tell him what's actually sitting inside it. And inside, these 3 barely look like the same kind of thing. Look at where the money actually sits. VOO is 38% technology. NVIDIA alone is 7.5% of the fund. Then Apple at 6.58%, Microsoft at 4.29%, and nobody on the inside is picking those. VOO just owns all 518 companies in the S&P 500 by size. So whoever's biggest gets the biggest slice automatically. There's no ceiling on how far one name can climb. SCHD looks nothing like that. Healthcare is the top sector at 20.67%. Consumer defensive at 18.75%. Energy at 14.04%. Technology sits at just 12.44%, which is about a third of VOO's. And the top holdings are Home Depot, Merck, United Health, Amgen, all bunched between 4.2 and 4.6%. There's no giant anywhere. And there's a reason for that tech gap. SCHD tracks an index that won't even look at a company unless it's paid a dividend for 10 years running. Then it ranks whatever survives on cash flow against debt, return on equity, yield, and dividend growth. The top 100 get in, And every March, when they rebuild it, nothing's allowed to sit above 4% of the fund. It drifts up a bit over the year, but nobody ever gets huge. Most of the big tech names just haven't been paying long enough to qualify. Then there's JEPI. Its number one holding is something called an S&P 500 Index ELN. It's 13.73% of the whole fund. The next biggest thing in there is AbbVie at 1.73%. So what is an ELN? It stands for equity-linked note, and the note part is the important bit. It's a loan agreement, basically written up by a bank. Here's how it works. About 85% of JEPI sits in a pretty normal basket of steady large-cap stocks, nothing weird. The other 15% goes into these notes. The bank sells call options on the S&P, collects the premium, and that premium flows back to JEPI as cash. Then it goes straight out to shareholders as dividends every month. That's the reason why this fund charges 0.35% in fees. Somebody has to run that trade, and they need to get paid. But it does mean John's biggest position here is basically a contract with a bank. Now, here's what's strange about all this. John looks at these three and figures VOO is obviously the spread out one. It holds around 500 companies. SCHD, meanwhile, holds 104 and JEPI 115. That's just how the math should work. Well, it doesn't. SCHD keeps 41.92% of its money in the top 10 names. VOO keeps 36.33%. And JEPI, the one with the banknote sitting at the top of it, turns out to be the least concentrated of the three at 28.17%. The thing is, with VOO, 500 companies isn't 500 equal slices. NVIDIA, Apple, and Microsoft alone are pulling almost 20%. And they get there on their own, since nothing's stopping them from growing into it. Meanwhile, SCHD caps everybody at 4% every March, so the money sits flatter across the top. There's just a lot fewer names for it to sit across. One more thing on that. VOO swaps out roughly 2% of itself in a year. SCHD updates the whole thing every March and rebuilds about 30%. JEPI runs 172% turnover. So if John holds it a year, almost nothing he originally bought is still in there. Now, in a couple of minutes, you'll see how all of that hits the projection. Which one of these turns John's $100,000 into $4.6 million? Which one pays him $13,000 a month? And which one's actually the better deal? But those projections don't come out of nowhere. Every number in them is built on what these three funds have actually done. So before we run the projections, let's look at their records. I'm not going to dress this one up. Over 10 years, it wasn't close. VOO returned 243% on price alone. SCHD did 136%. JEPI did 14.65%. And that number needs a caveat because JEPI didn't exist for the first 4 years of that window. None of these include dividends either. This is price only. Now shrink it to 12 months. SCHD did 26.3%, VOO did 18.2%, JEPI did 1.68%. SCHD went into this year loaded up on staples, energy, and healthcare, and that's exactly what worked. JEPI barely moved. And that's kind of the whole point of it. Over the past year, JEPI traded between $55.10 and $59.90, under $5 of range on a $57 share. SCHD's range covered about 30% of its price. Now the dividends. This is where it gets strange. JEPI has the highest yield here at 7.99%. It also has the worst dividend grade of the three, a D+. Every growth window it has is negative, down 3.6% over the past year, down 7.49% over 3 years, down 0.77% over 5. Look at what it actually paid out year by year. $3.23, then $4.16, then $6.63, then $4.62, $4.22, and $4.72. Those numbers climb, then fall back down, then climb again. And JP Morgan's own numbers explain why. Since launch, the actual dividend piece of that yield has averaged 1.43%. The options premium piece has averaged 7.18%. Those don't add up to 7.99% because they're measured over different windows, but the ratio is what matters. Most of what people call JEPI's dividend was never a dividend at all. And option premiums get fat when the market's scared, so JEPI pays John the most in the exact years his account is getting hammered. That creates a problem for the projection. JEPI has no 10-year growth rate because the fund launched in 2020. So we're running it at 2%. And I want to be straight with you, that's an assumption, not a measured number. SCHD gives us the opposite situation, 10.24% dividend growth over 10 years and 14 straight years of raises. Meanwhile, VOO sits in between at 6.26%. So that's the record. Now let's see how it's projected into the future. John puts $100,000 into each one. He adds nothing after that. Dividends get reinvested, and he leaves it alone. Here are the three sets of numbers driving these projections. SCHD comes in with a 3.14% yield, dividend growth of 10.24% a year, and share price appreciation of 8.98%, a fairly even split between its two engines. JEPI's yield is more than double that, at 7.99%, but its share price has only moved 1.32% a year, and its dividend growth is the 2% we just talked about. VOO flips the whole thing, a 1.08% yield, 6.26% dividend growth, and 13.18% annual appreciation, which is where basically all of its work gets done. Let's break it all down, starting with SCHD. By year one, John's balance is projected at $112,120, paying $3,140 across the year, or about $262 a month. By year 10, projections show $319,121, paying $831 a month. Year 20 is where it gets interesting. That account is projected to cross $1 million, $1,059,313, and it's paying $3,113 every single month while it does. And by year 30, SCHD lands at $3,676,264, projected to pay $146,238 a year, which is $12,187 every month. Here's how that got built. Share price growth adds $2,445,422. The reinvested dividends add another $1,130,843. So on top of the $100,000 John started with, the projections show $3,576,264 in value added. Now JEPI. JEPI starts fast. By year one, John's balance is projected at $109,310, and it's already paying $7,990 across the year. That's $666 a month, while SCHD at that time is sitting at $262. So JEPI's handing John 2.5 times more right out of the gate. By year 5, that account is at $156,845, with the income projected at $11,756, or $980 every month. By year 10, $249,158 in the account, paying $19,269 for the year, or $1,606 a month. Then year 20, the balance is projected at $654,320, and the dividends land at $53,859, which works out to $4,488 every month. And by year 30, JEPI is valued at $1,817,247, projected to pay $159,153 across the year, which is $13,263 a month, the biggest check of the three. The build on this one looks nothing like SCHD's. Across 30 years, the share price only adds $215,058. Meanwhile, reinvested dividends add $1,502,189. Total value added comes to $1,717,247. Then there's VOO. By year 1, John's balance is projected at $114,260, paying $90 a month. By year 10, $370,030, with dividend income of $154 monthly. By year 20, it's projected at $1,320,902, paying $3,219 for the year, or $268 a month. And by year 30, VOO is valued at $4,633,036. The income that year lands at $5,519, which is $460 a month on $4.6 million. And the split here is lopsided in the other direction. Share price growth adds $4,449,394, while reinvested dividends add just $83,642. Total value added, $4,533,036. Sit with that. VOO's entire annual income at year 30 comes to $5,519. JEPI paid $7,990 in year 1. So after 3 decades of compounding, VOO's yearly check still doesn't catch JEPI's very first check. And yeah, the obvious objection, VOO holders don't live on dividends. They sell shares. That's fair. And it's a real strategy. It's just a completely different one than the other two are running. So John's got all the information now, which means he has to actually pick one of these. Let's just tally it up. VOO takes cost at a low 0.03%. It takes diversification with 518 holdings and 2% turnover. It takes the last 10 years at 243%, and it takes the biggest balance at $4,633,036. JEPI takes income today at 7.99%. It takes the biggest projected income at year 30 at $159,153, and it takes stability with that $5 trading range. SCHD takes the last 12 months at 26.3%, and it takes the income growth record, 10.24% a year, with 14 straight years of raises. So the final count, VOO 4, JEPI 3, SCHD 2. So VOO won more categories than either of the other two, and yet it's only projected to pay $460 a month, which tells you the scoreboard was answering a question nobody asked. And here's the honest answer to that question. VOO makes sense for the investor who believes the balance is the whole point and is planning to sell shares to live. JEPI makes sense for the investor who wants cash now and is okay with a check that tracks market volatility instead of company earnings, and is also okay with $100,000 landing at $1.8 million instead of $4.6 million. John? Well, he chooses SCHD. Why? Not because it won anything, but because he doesn't know which version of himself shows up at 65 years old. He might want the cash. He might want the pile. SCHD is the only one of the three that doesn't make him guess correctly today. Now, which one you would take also says something about you. Okay, so VOO just won more categories here than anything else, but it isn't the only fund holding those exact same 500 companies. IVV holds them too, and $100,000 in both of them didn't land in the same place. Check out the video on your screen to see why.